All right, we are closing the books on Friday, January 9th, 2026, and the headline here is pretty simple. Record highs, all major boards to end the week. The S&P 500 finished up 0.64%, securing a new closing record at 6,986.76.
And that's a big level.
Huge. Then you have the NASDAQ Composite, the growth engine. It
Mm-hmm.
it really led the charge today. Closed at 23,688.31, tacking on 0.8%.
Right. And even the Dow joined in.
Yeah, the Dow Jones Industrial Average had added 0.58%, finished at 49,570.99. So that's another new record.
And if you zoom out, the whole week was like that. We wrapped up about 2% higher across the board. But I think what should really catch your eye if you're looking at today's data is that the risk appetite was actually highest outside of the mega cap names.
Oh, you mean the small caps?
Exactly. The Russell 2000, the RUT, it tracks those smaller companies. It was the day's real outperformer, climbing a powerful 1.11%.
That's not what you'd expect.
No, it's not typical behavior when you think it's just a handful of giants driving everything.
Okay, so that's the scoreboard. But the big question, right, the one everyone's asking is why we got here. I mean, this felt like a classic momentum move, but the driver wasn't pure strength. It was ambiguity.
It really was.
You had this mixed data, yet the market just rockets to within a stone's throw of Dow 50K. What was the core catalyst?
It was the ultimate Goldilocks jobs report. The market, it got to eat its cake and have the Fed easing icing, too.
Okay, break that down.
Well, the non-farm payrolls report missed expectations. I mean, missed them significantly. We only printed 50,000 jobs.
Versus the 70,000 expected.
Right. And that weakness, that usually signals trouble.
Absolutely. Less hiring should spook investors. It's a sign of, weakening future demand.
But here's the twist. Here's where the whole interpretation flipped. The crucial countermove was the unemployment rate, which surprisingly dropped to 4.4%. And so investors immediately priced this as the perfect low inflation scenario. A low hire, low fire economy.
It's the sweet spot.
It's the absolute sweet spot where recession fears ease just enough, but the overall labor market softness, well, it keeps the Fed on a path for gradual easing. That interpretation drove this entire trend day.
That perfect narrative is compelling, but it feels like we're sailing directly into a dense fog this weekend. Before we look at the internal health of this rally, we have to talk about the elephant in the room.
The Supreme Court.
The Supreme Court ruling on the administration's sweeping tariff policy. It's looming pre-market Monday. I mean, that is a massive market-moving hook that could instantly vaporize these Friday gains if the court sides against the administration.
You couldn't have put it better. The policy fog is incredibly thick, and that sheer uncertainty is reflected in how institutions treated this record close.
They didn't buy it.
They lacked the conviction. They did not truly commit capital ahead of this policy sword of Damocles hanging over the market.
Okay, let's unpack that conviction,
Yeah.
or maybe the dramatic lack of it. Looking at the internals, this record high happened on dramatically thin volume. So to put that in context for you, Dow volume tracked at approximately 157 million shares today. That is less than half the 30-day average of about 320 million.
And that is the single most important. So what for you to take away from today? A record high on thin volume means this rally is porous.
Porous?
It was not driven by confident, aggressive institutional accumulation coming in and buying up stocks. No, it was driven primarily by a sheer lack of sellers.
So everyone was just sitting on their hands.
Paralyzed by the mixed jobs report, and they just opted to let their existing hedges expire, which naturally pushes things higher.
But doesn't that inherently make this whole rally unstable? If institutional conviction isn't backing the move, it sounds less like a celebration and more like a setup.
It absolutely does. The danger here is clear. If next week's key data, specifically the Consumer Price Index, the CPI, which is coming out on Tuesday,
Right.
if that forces those institutions to hedge or reverse their positions, we are looking at an immediate violent volatility spike. We're already at this huge psychological crossroads, right? Dow 50K, S&P 7K targets are right in front of us. But the financial foundation holding us up is surprisingly brittle.
So if the big money wasn't broadly buying the close, what were they doing? Let's talk about institutional behavior and market breadth, because the numbers here, they paint a fractured picture. This really screams divergence.
The action today was defined not by a broad buy-the-market order, but by a very surgical rotate-and-fade strategy.
A rotate and fade.
And the evidence is just irrefutable in the breadth data. The NYSE advanced decline ratio, the AD ratio, was 0.8 to 1.
Meaning more stocks fell than rose.
Exactly. More stocks fell than rose today, even as the main index hit an all-time high. I mean, that is the perfect illustration of a fragmented rally.
That's a massive red flag. It just
Right.
completely contradicts the headlines.
It creates a major bearish divergence. The S&P 500 is being carried near its all-time high by that handful of massive mega-cap names. But if you look at the equal weight S&P 500, the RSP,
Which tracks the health of the average stock.
right, it gives equal weight to every company, regardless of size. And the RSP is actually down 2% over the trailing 5-day period.
Wow.
Price is leading aggressively, but breadth is utterly failing to confirm. And when you see that historically, it often signals market exhaustion.
So the rotation was targeted and aggressive. Where exactly did that capital flow? You said it wasn't a broad buy, it was surgical.
We saw definite leadership in cyclicals and some deeply defensive plays, specifically energy and materials.
And what was driving that?
It was a mix of micro and macro. On one hand, you have merger talks, particularly between major players like Glencore and Rio Tinto. And on the other, you've got persistent geopolitical tensions. We're talking Venezuela and Iran. That's driving crude prices higher.
So it's not risk-taking.
Not at all. That's money moving out of speculative growth and into resource scarcity hedges.
And the source of funds for this move was clearly the growth sector. Big money is actively harvesting profits from those high multiple tech stocks, which is just an archetypal defensive shift. Let's look at the specific stock action that supports this divergence narrative, starting with the biggest name on the board.
The profit-taking in Nvidia was just aggressive. NVDA opened with some early momentum but faced aggressive selling pressure right into the close.
How did it finish?
It finished the day down a sharp 2.2%. That's a huge fade in the most important momentum stock on a day the S&P hit a record.
So this isn't just selling.
No, this is institutional de-risking in the highest multiple names. It's a clear sign of risk aversion hiding right beneath the surface gains.
But not all tech was created equal. We did see a new thematic trade emerge that held its gains, and it points to some longer-term commitments. Let's talk about the nuclear breakout.
Yes, the AI power trade is suddenly a high-conviction thematic bet. You saw Vistra, VST, up a blistering 14%, and Oklo, OKLO, surged 17%.
And they held those gains.
They were buy the close darlings. Held those gains following the news of Meta's massive 6.6 gigawatt nuclear energy deal. For you, the listener, this signals genuine institutional commitment to the long-term infrastructure, the actual power generation, required to support the AI build-out. That commitment is a powerful day 2 continuation watch.
And meanwhile, we saw a classic housing head fake. Rocket companies RKT and Lennar, LNN, completely reversed their early gains.
It did.
And this was despite some headline comments from former President Trump about a $200 billion mortgage bond purchase plan. It just seems like institutions are fading the feasibility of those kinds of fiscal promises, especially with that looming Supreme Court tariff ruling casting a shadow over future policy.
The market is treating any new sweeping fiscal policy promise with extreme skepticism right now. And that Supreme Court ruling is the immediate, real-world hurdle that defines the risk.
Let's pivot now and talk about the fear gauge itself. If we're setting record highs, our natural expectation is for implied volatility, the VIX, to be absolutely crushed. But that is not what happened.
Not at all.
The VIX is sitting at 15.69, up slightly, about 1.5% on the day.
This is critical data. Implied volatility was not crushed. We call this vol-sticky behavior. It means traders are actively refusing to sell premium.
They're paying up for insurance.
They are, and the question is why? Because the market is pricing in serious policy fog.
And if we look beyond the tariffs, what exactly is fueling this policy fog and keeping that volatility sticky above 15?
It stems from two key inflationary pressures. First, headline inflation is just refusing to drop below 2.7%. And second, today's hourly earnings data was sticky. It was up 0.3% month over month.
So that raises a big question.
It raises a very important question for institutions. Is the Fed put, the idea that the Fed will just step in to protect the market, is that still operative if wage pressure remains this firm? Institutions are buying tail risk protection ahead of the January 28th FOMC meeting because they are simply not convinced this current calm is going to last.
Okay, so we have a low volume record high, dangerously bad breadth, sticky volatility, and aggressive sector rotation out of growth. So what does this all mean for the week ahead? We've got CPI on Tuesday, January 13th, and then the bank earnings, Blitz, JP Morgan, and BofA kicking off the Q4 reporting season.
My bottom line remains consistent with the internals. We are in a low volume melt-up. I would expect choppy sideways action rather than a vertical continuation. The probability of a straight continuation next week is only about 40%.
Hello.
We need to digest this NFP miss and reposition for that crucial CPI print.
So let's get technical. Given all this options and gamma chatter, where is the critical level we have to hold to avoid a significant, painful reversal?
You need to keep your eye glued to the gamma wall. For those unfamiliar, that's the price level where options market makers have the largest hedging exposure, and a break there forces massive selling.
And where is that wall right now?
Key support must hold at 6,892 to 6,895 on the S&P 500. That was the high of Thursday's technical doji formation, a candlestick pattern signaling indecision, and it's the primary overlap support from Friday. The bulls are safe as long as we hold 6,900.
And what's the risk scenario? What triggers a sell-off?
A clean break below 6,800 triggers a nasty gamma squeeze to the downside. You'd be targeting 6,760 pretty quickly, so keep stops tight. But critically, you must monitor the 10-year Treasury yield, which is currently sitting at 4.18%.
Right.
If that yield breaks 4.25%, this entire thin volume rally evaporates instantly.
Why does 4.25% specifically matter so much to the stock market right now?
Because if the 10-year yield moves up aggressively, capital flows out of those fragile, high-multiple tech names and into safer fixed income almost instantly. It means this entire record rally is dependent on bond yields staying quiet. That 4.25% level is the threshold where passive capital starts to reallocate out of equities.
That sets the stage perfectly for the high-conviction day two plays. Given the backdrop of rotation and divergence, where should traders be looking for asymmetric opportunity come Monday morning?
The first asymmetric trade is long defense and energy. These are, they're recession-proof hedges against further tech profit-taking. And they proved their momentum today with energy up over 3% on supply risk. These names offer limited downside if the market stalls, but massive upside if the overall tech sector fails that gamma wall.
And for single stock setups, where is the unique relative strength?
Micron, MU. It's a high-conviction day two continuation play. It closed up 4% today on the back of a massive $390 price target hike from Mizuho. The semiconductor subsector is the only part of technology showing relative strength against that broader tech profit-taking we talked about.
So if you're staying long in growth, be in semis.
That's where you want to be.
And finally, what about a high-risk, high-reward contrarian setup?
Tilray, TLRY. It closed up 3% on a notable revenue beat, despite the noise of an analyst cutting their target.
A disbelief rally.
It's a classic disbelief rally. The market is skeptical of the move. If it holds the critical $9 level on Monday, the shorts who were betting against the company on that previous analyst sentiment, they will be forced to cover into the revenue beat narrative. And that could fuel a rapid spike.
An utterly fractured rally on dramatically low volume, driven by Goldilocks data, all hinging on a gamma wall support level tied directly to a looming Supreme Court ruling. What truly stands out to me here is not the record high itself, but the sheer cost of insurance.
Exactly. It's the refusal of the VIX to fall below 15, even with the S&P at a record high. That tells you that institutions are seriously hedging their bets and questioning the health of this low-volume run. The complex relationship between that sticky VIX and the 4.25% trigger on the 10-year yield is the ultimate policy hedge to watch next week. Stay nimble and keep your stops tight.
Fantastic analysis. That's our deep dive into the Friday close. We'll see you for the next one.